CBOE's Mandy Xu joins us now. She's the firm's head of derivatives market intelligence. Mandy, great to see you.
Hey, Melissa, great to be on the show.
So the data you're looking at shows that actually action was balanced, correct? That there wasn't this force driving stocks lower.
Yeah, before I delve into the activity of yesterday, I think it's really important to really start high level at the concept of what drives zero-day risk, right? Zero DTE option risk, and I think there's a misunderstanding that high volume in these products equal high risk. And yes, there's a lot of high notional volume, on average about 700 billion a day trade in these zero-day options, right? But what matters when we're talking about the market maker risk is not the total volume, but the balance of the volume between buys versus sells, the net positioning, which determines how much market makers actually have to hedge. And what we find is that the net positioning is actually very de minimis relative to the total volume, and therefore the risk of these products, we're talking on average only about 0.1% of the average S&P daily liquidity.
So let's go to yesterday's action then, and why so many people are pointing to 47.65 puts and vilifying it. I mean, this is a product that really people want to blame a lot of things for, and yesterday is a prime example. So can you walk us through?
Sure. So yes, there's a lot of attention being paid to the 47.65 strike put in the S&P yesterday. And then as the market kind of fell and went through that strike, people pointed to the high volume in that strike, right? 120,000 contracts traded in that particular strike yesterday. But to my earlier point, high volume doesn't actually mean high risk. So if we break down that flow in terms of what market makers were actually hedging, we see about 61,000 contracts were customers long, 62 with customers short. So it's actually remarkably balanced, such that the net imbalance that market makers were hedging, we're talking about 1,000 contracts, right? 1% of the total volume that actually market makers had to hedge. And if we kind of extend that analysis across all strikes, because again, market makers are not just hedging one particular strike, what we find is that yesterday, throughout the sell-off, for most of the afternoon, market makers were actually net long gamma, which is just a technical term that tells you that there were long options and they were hedging in the opposite direction of the market move. So as the market was selling off, market makers were actually buying futures to hedge their option position. So if anything, they were the stabilizing force in yesterday's sell-off, not the destabilizing force.
Mandy, this is Lori. Whenever things in the options market end up going a little bit haywire, the question that comes to me is how much is retail driving this, and is this like what we saw in the pandemic? And I'm just curious whether you're thinking about yesterday or just in general with these zero-day options. What's your view on that?
Yeah, that's a great question. So in zero-day options, we do see a fair amount of retail activity. So our estimate is about 40% retail, 60% institutional. So I would say a pretty healthy balance. But to your point about, is this like, for example, what we saw in the pandemic? Certainly, I think there's a tendency for people to conflate the two, given that they happen in quick succession. But what I would say is that the activity that we're seeing in zero-day option could not be more different to what we saw in 2021 during the pandemic, meme stock era, right? That was a time where the option activity we saw was very much one way. It was investors buying upside calls to speculate on the direction of stocks, right? And all of it was bullish activity. And of course, when the market started going down in 2022, all of that activity dried up. What we're seeing in SPX zero-day options is a very balanced flow in terms of investors buying these options either for hedging or for speculation, but also a very significant percent of the volume is investors selling these options for income generation. So that diversity of use case, again, is why the flow in the zero-day options is so balanced, and why we continue to see very robust flow in zero-day options, regardless of what the market is doing, whether it was last year market down 20% or this year market up significantly. It's been very consistent and agnostic to the direction of the market.
Last quick question, Mandy, and I understand for the SPY, it's deep, it's liquid, et cetera, but there are also zero-day expiration options on single stocks, on ETFs, and are there opportunities in sort of the more thinly traded areas to cause more volatility where there isn't as much balance as we're seeing in SPY?
So not quite in single stocks yet. So yes, SPX by far is the deepest, most liquid market where we have zero-day options. We also have it right now. When we call zero-day options, really talking about the availability of expiry, every single day. So right now we have it in the SPX family, so SPX, SPY, E-mini, and we also have it in the NASDAQ family. So NDX and the Qs. Right now, there are actually no zero-day options available at the single stock level, and I think there's definitely going to be logistical challenges in terms of extending it to single stocks. One of, I think, the unique features of index options is the fact that it is cash settled. So the risk, of settlement at expiry is, very, very de minimis relative to, say, a physically settled ETF option or single stock option. So that is something I think, definitely a hurdle that the market needs to overcome if they were to expand this to single stocks.
Okay.